Okay, so this part of the module, we're going to talk about how to use either private money or hard money loan to purchase a rental property, make repairs, then refinance it using conventional, which in some cases can bring the total money you have invested to zero. Sometimes it can even get you money back if you do it correctly. So, before we really get into it, this is a risky strategy. You really have to make sure you know your numbers very well, know your market very well, understand that appraisals don't always come in where we think they're going to, so best be very conservative with this method. It's kind of like a hope for the best, hope you can have less money into it, but plan for the worst in case things don't go as planned. Another thing to consider too is cash flow. If you're putting no money into a house, depending on the deal, your area, obviously it makes it tougher to cash flow. So I'm not a big proponent of borrowing every single dime you can if it means you're not making any money or you're making negative money. I don't think we're in this game to just buy houses just to buy houses that don't make money. We're in this game to buy houses that do make money. So it's all a numbers game. You really have to know the numbers really well whenever you're buying rentals, buying flips, and especially using this strategy because it can be risky. Doesn't always go as planned. Like I mentioned before at the start of this module, I wish I would have used this when I bought some of my first properties, when I could have had less than 10 mortgages. Because it's a very interesting strategy. I know quite a few people who have done it, and it helped them really get started buying rental properties quickly without having as much money down as you might think you have to have. So here's the basic premise of this technique. Conventional mortgages that are backed by Fannie Mae, once you have 1 to 4 mortgages in your name, you can do a cash out refinance usually with those conventional mortgages. Once you get to 4 or 5 to 10 mortgages though, they don't let you do a cash out refinance anymore. So a lot of people think, well, that is limited a lot of my options, not a very good loan if I ever want to refinance, take some money out. But there's some very interesting points when you're dealing with these Fannie Mae loans. There's no seasoning period if you don't do a cash out refinance. So you can refinance the property if you don't take cash out with no seasoning period. So you can do it in a month, 2 months, 3 months, as long as you're refinancing another loan and you're not getting any money out of it. So that's where the private money and hard money loan comes into play. So the strategy goes like this. You find a rental property, it's a great house, maybe it's $100,000, needs $10,000 in work, but you think it's worth $150,000, $160,000 once it's all fixed up. So you buy the house with, say, hard money. Maybe you have a private money lender who'll give you a loan on it. Sometimes a hard money lender will do the repairs plus the purchase price if you have a good relationship with them. Sometimes a private money lender will do that too. So let's say, best case scenario, you're able to finance $110,000, the purchase price plus repairs. Now, that's not always going to happen in the real world, especially if you're just starting out with a new lender. They may be a little wary of lending you the full purchase price plus repairs, but it can happen. So we're going for best case scenario first. So you get this loan, it's $110,000. You buy the house, you make the repairs. What you do next is you refinance that loan with a Fannie Mae mortgage. Now you can't take cash out, but you can finance that entire $110,000 that you borrowed from the private money lender or the hard money lender, as long as the appraisal comes in high enough. So you can get a new appraisal after the home is all fixed up, hope it comes in high enough so that 75% of that new appraisal value covers all of your costs. So if your appraisal comes at $150,000 after you've done the repairs, home is in great shape, 75% of that would be $112,500. So with Fannie Mae guidelines, you can do a refinance for 75% of the purchase price. As long as you don't take any cash out, you're fine. So you would get $112,500 covers your $110,000 loan. So you just refinance the property, $110,000, 30-year fixed loan. Who knows what interest rates are depending on you as an investor, but probably 4.5%, maybe 5%. That's not bad for being able to finance all of your down payment plus the repairs as an investor, not using any owner-occupied strategy, simply buying it, repairing it, refinancing. Now, the things to remember with this strategy: it will cost you more money than simply putting 20% down making the repairs, because you're doing two separate loans. So, hard money is going to be expensive, probably 10 to 14% depending on the lender you use. Probably have to pay a couple of points when you get that loan. So if you got the house going for a couple months, few $1,000s at least in costs there, probably more than that, maybe even $5,000 in loan costs. Then you're going to refinance it to the Fannie Mae loan. You're probably paying another couple percent in loan costs for that as well. Origination fees, prepaid interest, all of that. So it's like getting two loans within one. So obviously your costs are going to be higher. Again, that's why you have to make sure your cash flows well, and you're just making a good investment. You're not just buying to buy with no money. But if you can do that with the right numbers, great way to get started. Keep doing that over and over again. If you can find a lender, a private money lender, a hard money lender who will do it, you can basically buy investment properties with almost none of your own money up until you get that 10th mortgage, and that's when you'll pretty much be stopped from doing any more Fannie Mae mortgages. Of course, if you're married, you have a husband, wife team, you both have a job, you both have good credit, you can do Fannie Mae mortgages in just one of your names. So 10 for the husband, 10 for the wife. I've seen many people use that strategy, get up to 20 properties, 30-year fixed rate loans at incredibly low interest rates. Great strategy to move forward. The thing to remember when you're doing these hard money, private money refinances is the appraisal has to come in at that higher price, or else you won't be able to get the loan you want to get. So if the appraisal comes in, at $130,000, then you're going to be financing less than $100,000. That's going to be 75% of whatever that appraisal comes in at. So if you're planning, if you've got this $110,000 loan that covers the purchase price, repairs, you've got no money, no reserves, and all of a sudden your appraisal comes in at, $130,000 and your loan's going to be under $100,000, you're bringing $15,000, $20,000 to pay off the hard money lender, the private money lender, after you get that loan. So you have to be very careful that you have that money available. Worst case scenario, if the appraisal doesn't come in where you want it to, or something else happens, because you can never count on an appraisal for a refinance coming in at value. I have learned that over the years. I've refinanced a number of my properties, and they almost always the appraisal comes in less than I think the house is worth. I know what these houses are worth. That's what I do all day long. That's how I can get such great deals, act so fast, because I know the market values. So I see appraisals come in 10% low. I've seen them come in lower than that. I've had houses I thought were worth $150,000, $160,000, and the appraisal came in at $132,000. I'm like, are you kidding me? How can you possibly appraise this house so low? And there's really nothing I could do about it. Some lenders might let you get a new appraisal. If you want to switch, try it again, but then you're paying $400 or $500 a pop for each of those appraisals. There's no guarantee it's going to come in better. So you've got to be prepared for the worst case scenario, hope for the best, but make sure you know that there's a chance you won't get all that money you borrowed back from the hard money lender, private money lender, and you'll have to put some of your own money into the property. So that's everything I've got for the hard money, private money refinance strategy to buy rentals with less money down. Much more information coming, and we'll get to it here soon.